Canadian inflation numbers are out, and unfortunately there is not much positive news for us. Now, it did go down to 6.9% in September from 7.0% in August, so it went down a whopping 0.1%. It is the third month in a row of declines, which sounds good, but unfortunately the pace is quite slow, and it's in the midst of many goods and services continuing to get more expensive, with the biggest of those being food. Food has increased at a rate of 11.4%, and that's the fastest pace of increase in your grocery bill since 1981. The biggest thing the Bank of Canada will be taking away from the latest inflation numbers is the need for higher rates to try and further cool the demand in the market. Hey buddy, this is Jonathan Lerner from the Vancouver Life and eXp Realty, here bringing you all the updated real estate news and information you need to be able to understand the market and make the best decision possible to have a return on your money, whether you are purchasing or looking to sell. The core rate of inflation, which takes out energy and food and a few other factors which are much more volatile, once they take that out, you have core inflation, and that remained unchanged from August to September, which is, to be honest, it's a disturbing sign that inflation is really starting to become entrenched, even as the Bank of Canada is raising these rates aggressively to try and rein that inflation in. Andrew Kelvin, Chief Canada Strategist at TD Securities, has said that even though the headline numbers have moved lower, it does look like the inflationary shock is spreading. He also thinks that it's going to intensify the conversation around whether the Bank of Canada needs to lift rates by either 50 basis points or 75 basis points next week at the Bank of Canada's next rate announcement on October 26th. After these numbers, Scotiabank has come out and called for a 100 basis point hike, particularly or specifically towards variable rates. Scotiabank is really trying to sound the alarm of this downward trajectory of the Canadian economy, warning that we are going to be heading into a recession in early 2023 as a result. And it will be accompanied by rates as high as 4.25 to 4.5% as the base overnight policy rate. According to Scotiabank chief economist Jean-François Perrault, Canada's economy is expected to contract substantially over the next 12 months, with GDP growth slowing from a current 3.2% down to a paltry 0.6% next year, which again will bring us into a technical recession in 2023. All of this is also on top of RBC releasing their report last month that said housing affordability is at its worst in 31 years. And with these increase in rates that they are looking to do to, again, try to rein in inflation, it is only going to make housing affordability even worse. I'm also going to be doing another video shortly on rental rates and how the numbers work with today's interest rates versus the rental rates that you can get, because this could still be a sound investment if you can get the right property, because rental rates are at their peak that they have ever been as well. So I'm going to be doing a video breaking down those numbers to see what that looks like. As for the next rate hike from the Bank of Canada, I'm putting my money on a 75 basis point hike, and I would love to see and hear what your prediction is, so throw that down in the comments down below. Now, if you got some video from this video, please like, please subscribe, please click on the bell to get notified of future videos, and if you think someone else could get some value from this video, please share this video, send that link out, and share it with the world. All right, we will see you soon, everybody. This is Jonathan Lerner from the Vancouver Life and eXp Realty, bringing you everything real estate news related, as well as updates, information, properties, and everything that you need to know to be on top of the market and what is happening.